Thank you, Abby. Thank you too, Larry. Let me, one fact that I think I got right when I was looking at a table the other day, which Abby touched on, the importance of education. But she didn't go down to males who have not got a high school degree. I believe 46% only of those men in the age group 25 to 55 are employed in permanent employment. I mean, it just, the importance just of a high school degree, let alone. Anyway, let me just, maybe we get both of you, but when you look at, you cite the fiscal restraint that Europe's going to have, the fiscal restraint that I think we're going to have. And you look at some of the China and slowing down, and Brazil slowing down a little bit, other parts of the world slowing down. Certainly you touched on Europe. What do you see as the growth rate for 2012 and 2013, if you make a prediction? And Abby, go ahead first.
The growth rate that we have projected for next year for the United States, we have recently reduced. So we think growth will be somewhere between 1.5% and perhaps 2% next year, which is slower than the current growth rate. And the two primary factors that we think will be impeding growth in 2012 will be, as I've already mentioned, what's going on in Europe and how important that is to our trade and exports. And the other thing is these austerity measures from the federal government and also state and local governments. I'm going to quote Lord Keynes, who basically said, the right medicine at the wrong time is the wrong medicine. Currently, I believe that what ails us more than anything else is inadequate demand in our economy, growth that is too slow, unemployment which is too high. And to look for fiscal rectitude now, in my view, is not the right thing. Long term, absolutely. Long term, we need to get our fiscal house in order. But I will give you the following throwaway, just sort of a rule of thumb. What year is it that the deficit really becomes a problem? 2022. Why? Because the real issue for the U.S. deficit is related to Medicare, which is not properly funded. The unfunded liabilities of Medicare are about 7 or 8 times larger than those for Social Security. So the issue is Medicare. 1957, peak of the baby boom, adds 65. 1957, 65, 2022. Okay? Short term, the U.S. budget deficit doesn't look all that terrible. I know it was terrible last year, right? Approaching 9, 10% of GDP. But it's not just the numerator. It's not just the size of the deficit. It's the size of the economy. Most economists would agree that the best way to reduce a deficit is to grow in a healthy fashion. And when you have, as we did, a severe recession and GDP became much smaller and the need for counter-cyclical spending increased and tax revenues went down because people weren't earning as much, either at the individual or corporate level, that's what really clobbered us. Here are the numbers from the non-partisan Congressional Budget Office. Okay? The CBO does the official scoring of the U.S. budget regardless of who's in power. The Democrats use the numbers, the Republicans use the numbers, and so on. The fiscal year which just ended, did you know that the U.S. is on an odd fiscal year? Isn't that fabulous? Odd fiscal year? Okay. September 30th, the fiscal year ended, and the U.S. budget deficit was between 8 and 9% of GDP. Down a little bit from the worst part of the recession, but still higher than we would like. This nonpartisan CBO estimates that in fiscal 2012, which began on October 1st, that's going to decline to 6.2%. And they said if growth begins to approach the potential of the economy of 3%, it's not going to be a 6% deficit, it's going to be a 3% deficit. And the numbers that they show for the out years, 2013, 2014 are deficits of 2% of GDP and below. Now, I recognize these are still deficits, and we'd like surpluses, but just to put this in historical contrast, during the Reagan administration, the budget deficits averaged 5.5% of GDP. During Mr. Bush's term of office, Mr. Bush #2, budget deficits ran typically 3 to 4% of GDP. If the CBO is correct, we are going to be dramatically below those numbers in just a year or two. So I'm going to come back to Archie's question. 2012, we think economic growth will be somewhat below potential because of the issues raised, fiscal austerity, and Europe. 2013, we think we start to move back towards potential because the problems in Europe, we think, will be gradually resolved. Larry did a very nice job of describing why it's going to take them a while to get their act together, but at some point they will. We believe that there are areas of traction developing in the U.S. economy. And once you've got that traction, it becomes reinforcing. That is, once consumers start to feel better, they start to spend more. As they spend more, more people get jobs. It's a slow process, but we think things will look better 18 months from now than now.
I think I'm right in saying that that sort of growth in 2012 is not enough to bring unemployment down. Larry, your view?
Yeah, I just want to start by saying, Abby, you take the under on those numbers, I'll take the over, and we can put any stakes you want. That's, I mean, I don't know if you know, but those numbers, I keep getting a buzz on this, assume that all of the legislation that's in place now stays in place, meaning the payroll tax cuts expire, the Bush tax cut, I mean, so it's just, those numbers aren't, I mean, it's just not going to happen. So, I mean, what I said before, I stick with. I don't think we have a debt crisis now in the United States, but I think if we don't start, I think if we wait till 2022 to start addressing this, forget it.
I didn't say to start. I just said that's when it hits the fan.
Well, that's when it's really gets crazy, but because, as you say, of the health care. But so what do I think growth's going to do next year? First of all, I think part of this plan of President Obama's will be passed. I do think they will extend the payroll tax cut and even expand it. You know, I think they'll also extend the investment tax credits. Some of the other stuff I think they won't do. And I think, but this is a big wild card. And how much of the spending programs, as Abby noted, state and local government spending is going down. And a lot of this came because the first stimulus program contained a lot of grants to state and local governments, which then expired, so then they had to make these very big cuts. And so I think what happens with policy, and remember last year, the payroll tax cut, for example, came in December, I think. I mean, it came at the very last minute. And so I don't think we're going to actually know what fiscal policy next year is going to be until the very late in the year. I personally think even December is when we're going to find out. And I think that's going to play a big role in whether you get a 1.5% economy next year or a 2.5% economy. I would say one thing, I mean, I think...
But you think that's the range?
I think 1.5, 2.5, but I think, I think on Europe, I think the window is actually closing. In other words, the markets are giving them less and less time to come up with a solution here. So I actually think this is going to go one way or the other. Either this thing's going to get very nasty. I don't think it's going to take more than 6 months. And even if, I mean, I mentioned before that a sustainable solution does require constitutional changes even to the EU Constitution. However, I don't think you got to wait for that, for this thing to stabilize the crisis. In other words, if the leaders of Europe get behind a plan along the lines of what I was talking about, that meets the criteria of providing sustainable financing rates and also guarantees that these guys do the right thing, nobody's going to be shorting Italians debt anymore, and you'll get a stability. So I don't see this Europe. I agree. I think European growth looks very bad in the next 6 months, but I think sometime out there that problem either goes away or it's going to be a lot worse. Say one more thing about the U.S., and that is in terms of the growth outlook. What's going on in housing to me is the main thing that is preventing a more robust recovery. So if you look at residential construction in the single-family sector, by the way, multifamily construction is actually going up, but in the single-family, it's doing nothing. It's been dead. And the main reason is you have this massive inventory of foreclosed homes that still have to get through the market. In addition, even though mortgage rates are at an historical low, most people cannot get access to these very low rates. Most of the federal programs that have been put in place to help housing, it's amazing to me that this is true, but you've had to be delinquent on your loan to be eligible. Talk about perverse incentives. There are millions of people who are making their mortgage payments and struggling to do it, and they can't refinance their loans at these 4% mortgage rates. There are ways to do this. They're fraught with political potholes is the problem. This would provide a huge boost to the economy, in my view. And these interest rates are there. The mortgage rates are there. The interest rates are, it's not the problem that interest rates aren't low enough. They've never been lower. It's the problem of getting access to these very low rates. Whether they, get around to doing this, maybe it takes place after the election. There are ways to do it, but to me, that's the big thing. In other words, usually what happens, right, you get interest rates way down, and the interest rate sensitive sectors are the thing that cause you to have the robust recovery and those things. Now, part of it is we went through a credit boom and bust. There's reparation of balance sheets and so forth, so it's not everything. But a lot of it is that the housing market is stalled. It's just stalled, and it's not going. So you're seeing one reason why multifamilies are growing is the rental markets are picking up, not the new home markets, and that's why the multifamily construction is actually rising.
Now, let's take a question or two from the audience. Yes. Go ahead.
Yes. Assuming that Abby's correct, that consumption will sort of bumble along, investment will stay healthy, and government will continue to contract because those are all happening from exogenous sources. What I didn't hear is, if the Europe thing does go south, that they don't figure out a way to do it, I wasn't clear in your growth prognostication what your assumption was of the impact from that very large export market that we have to Europe, if that goes down something like what happened in 2008, when you had this dramatic fall off in exports where they went down 30–40% across the board in a lot of places. And so I'm not clear as to, are you prognosticating a negative effect on exports from that quarter of that sector, or are you prognosticating something different in terms of it filtering into the overall rate?
Sure. The forecast that I began to talk about is the one that is prepared by the Goldman Sachs economists who are responsible for the European economy, and all of our teams work together. So the European-based economists come up with their most likely scenario, and then it kind of rolls its way through the rest of the world. And the presumption that we are making is that a recession, which we think is likely in economies in the periphery of Europe, will not be as severe as things that were seen immediately following the financial crisis, because the starting conditions are different. We see, for example, that inventories are under extremely tight control. We see that many adjustments have been made in many different sectors already. And so since you're not starting from the peak, you're starting from something like there, you really can't fall quite as far. It's like tripping off the curb instead of from a much higher height. That's a terrible analogy, but there you have it. The assumption that we're making is that recession is likely in Europe overall. We have a combined Eurozone forecast of 2012 of 0.1%, but we have sort of a +5 to +8 in places like France and Germany, which means other nations are negative. The impact on exports is something that we then factored in to our forecast for the United States, and I don't mean to go into excruciating detail here, but we previously had expected GDP growth in the United States next year of close to 2%, and we've knocked it down about 1/2 a percentage point because of Europe, and also the knock-on effects. Other regions of the world also deal and trade and export to Europe, including some of our trade customers in places like East Asia, South Asia, and Latin America. So if their economies are slowing because of the impact from Europe on them, that in turn has an impact on us. The knee bone's connected to the ankle bone and all the rest of that.
Any comments from either of you about the Occupy Wall Street movement?
Isn't it good I'm out of banking?
Yeah, I mean, this is dangerous territory. I think I'd say two things. One is, when you have unemployment as high as we haven't had unemployment this high in this country in many, many years, and you are going to get social unrest from that kind of thing. The other thing that's happened in the United States is income inequality has just continued to grow, and I think that also is the kind of thing that spawns social unrest. I mean, so that'd be. I don't think it's that surprising in this environment that you're seeing that kind of thing.
I think it's fair to say that from a political standpoint, the banks may be further vilified during the campaign, and it wouldn't surprise me to see more of it than we're seeing right now. Yes.
I would follow a little bit this question. This comment. Your CEO claimed just 2 years ago, we are doing God's work. Now dominate mood around the world, cancer of society, which grows and kills the body. You cannot ignore this. That's what you have to deal much more with all what you learn from Friedman, from Keynes and Krugman and all of them. That's main point, what you have to take in consideration. Mainstream believe that what you call financial sector, that's bubble after bubble, bubble after bubble, that sponsors him, and that's not just Occupy Wall Street. Vanity Fair would publish a huge article about Ponzi scheme as a whole American economy. And it's taken, that's not something extreme. And economy, that's psychology as well, social psychology, modern society. So what is your answer to all of the challenges?
What was the question?
I'm not sure we're here to debate, how good or how bad the financial system and the banks are, and I'm not sure it's fair to ask either of these two to answer that question. Let's turn to another question. Yes.
Good evening. It seems to me that over the years, a lot of the policies that both sides of the aisle have made have engendered some negative reaction, to wit, in the late 90s, we started exporting 50,000 jobs a month overseas. So many of the people who are alienated today without college educations are a result of that trend. Next, we had the TARP program, which people felt benefited the bankers and not other areas of the economy. Senior citizens who would very much like to perhaps put their grandchildren through college have been severely impaired by the lack of income that they're getting from the very, very poor returns in the bank, on which they still have to pay income. So for their own fear of what they would need with means testing and for their own needs, they're really not stepping up to the plate. And the last, I'm not even going to go into the insecurity of the derivatives, but there is one question that I would like to ask you all. recently, banks have been reporting this DVA, which seems to me that's the discounted value of their debt that they could buy back at a discounted price, and they take it into earnings. I'm concerned that that might further alienate investors. And I wondered what our administration on both sides of the aisle could do to further engender positive reaction to investors.
So I mean, I'm not sure there's a lot of stuff in there. You're talking about trade and jobs overseas. I think Abby made a very good point. I mean, the way I would phrase it is that the rate of return on education has gone way up. You know, there was a time in this country where you could earn a very good living and, in fact, have long-term security without a college education, in fact, sometimes without a high school education. And those jobs have gone overseas. And so you do have to be educated. My personal view is that this is imposing a large social cost, but long-term is a good thing. Why do I say that? The benefits of trade, the problem with trade is that the costs are very easy to see. You know, you see towns in Michigan and in the southeastern part of the country that used to produce textiles, you know, with people unemployed and all this. Meanwhile, millions of people are buying things like blue jeans and sneakers and things much more cheaply than they ever did before, and that's the benefit. And so not only that, but the job, and one of the problems we have with jobs in this country is a skills mismatch. So if you look, there's a thing called JOLTS data, which is jobs openings and leave. I forget what this thing stands for, but the gap between job openings and actual jobs has been growing because of a skills mismatch. So this takes a long time. I would mention that at the time of the American Revolution, over 90% of the population were in farming. And there was a lot of political pressure to try to preserve that way of life because it was a very difficult transition that way. If we did that, if we subsidized farming to keep that, we would not be a wealthy country today. It was a wrenching adjustment to move toward manufacturing at that time. Now we're moving to things like legal services, financial services, which are under attack, technology. You know, Apple's an American company. I mean, these are the things, and they require education. That's the thing. And I think, you know, investment in education, what Abby was talking about is, I mean, so we're spending, the federal government this year is going to spend about $3.8 trillion. Does anybody know how much the federal government spends on education? It's around $100 billion. That's it. When people, I laugh when politicians talk about education because you could double it or eliminate it and it won't make any difference to the deficit because it's so small. So that's the thing. I do want to say something about this whole controversy about banks because you got into that too. And the IVA, by the way, that's an accounting thing. And it works both ways.
It's an
So when the
accounting
debt goes the other way, the banks lose profit and it washes at the end. It just so happens right now the debt's gotten more expensive. So the yields have gone up, so they've gotten cheaper. So if they had to buy back the debt, it would be cheaper. And it's an accounting thing that's always been there.
But
All companies have.
It distorts earnings.
It distorts earnings. And all the analysts look through it, by the way. They all look through it. But let me just say something with the banking thing. And I work for a bank, so you can call me biased. The banks made a lot of mistakes during the financial crisis, but the idea that the banks were the sole cause of this financial crisis is a joke. Okay, and let me give you some examples. Did Congress have anything to do with it? We've had massive subsidies to the housing market for many years. And it's not just mortgage deductibility. There's all kinds of subsidies to housing. Fannie and Freddie are a good example. Now, that had nothing to do with it, the expanded value of housing. By the way, banks were pushed into making loans to low-income communities. It's very difficult to do that in the business sector. This spawned the subprime market. That's what it was about. It turned out to be not a good thing. They turned out to be risky loans. But they were, and by the way, the mortgages that were originated was almost none of that was banks. I don't know if you know that. You think Countrywide was not a bank. They became a bank later. American Century in California was not a bank. Almost none of the mortgages, in fact, were originated by banks. Now, banks are not blameless because banks took these mortgages, packaged them, got them rated by the ratings agency. There's another couple. Banks were giving these to the rating agency. We were stamping AAA. Now, you can fault the banks because you could argue they should have examined all these mortgage loans to see, because they then packaged them and sold them. But that's what the rating agencies were supposed to do. They were getting paid to examine these mortgages and rate them. They rated them AAA. They weren't AAA, we all know now. You know, these underwriting standards, this wasn't done by the banks. What about people who lied on applications and said they had income and all that? Did they get any blame? So, look, we know how society is. We have a high unemployment rate. People are angry. Income inequality has grown. People they want somebody to blame. Yes, banks did get bailed out, but remember, some of these banks actually were forced to take the money and got and by the way, does anybody know this? The government, you taxpayers, you made money on this. You made money on this. This was a great deal for taxpayers. You're not going to make money on Fannie and Freddie. You're not going to probably make money on AIG. You're probably not going to make money on the car bailout, but you might. But on the bank thing, you made money. In fact, J.P. Morgan screamed loudly about this because they didn't want the money. They got the money, and the payback they had to do to get out of it cost them a lot of money. So it's not, again, banks are not blameless. They were certainly part of this. There's no question about it. And by the way, right now, banks are not doing very well, and they're laying off thousands of people because they're not making money. And Archie's right. You know, this isn't over. You know, right now they're the poster child for, you know, greed and excess and causing the crisis and all this stuff. And, you know, it's going to you're probably right, it's probably going to get worse. But the idea that banks were the ones who caused this crisis and nobody else, it's a joke. That's not true. So anyway, maybe that's too ardent a defense, but it's not. Look at the facts.
I know we're running late, and I don't. Let me take a couple more questions. One back here. Yes.
Me, sir?
Just a second. Yes.
Abby, I know both you and Larry are bears from way back, bulls, I beg your pardon. And I'm sort of curious to know, where do you think the Dow's going to end by the year end? I want to get something out of
Here's a
this
good
lecture
question.
tonight. And Larry, do you think Germany might pull out of the EU?
No, let me say something that I didn't mention that's very important.
We have to keep
We'll
our
keep it short.
answers short.
But the monetary union was a political decision. If they end this thing, it'll be a political decision. Germany is very committed to this, and one reason when you talk to them privately, they hate the idea of the ECB, what they're doing and buying the bonds, and that's why Stark and Weber both resigned. They don't want to, this is like, you know, anathema to them for the central bank to be buying this stuff. But they are committed to the euro. Why is that? One main reason is they're benefiting tremendously from it. The reason why Germany's before monetary union, what would happen is Germany would never reap the benefits of keeping wages and prices under control. Why? Because whenever you'd have a crisis, these other countries would cut interest rates, their currencies would depreciate against the then Deutschmark, and all the competitive advantages would be lost. Now, they can't do that anymore. And Germany is killing it in trade, intra-Europe, killing it because they have kept wages and prices under control, and they're much more competitive than these other countries. That's one reason. The other reason is a political reason. I mean, Germany never felt that they had the weight in international military affairs commensurate with their economic power. Now through Europe, they feel they have a seat at the table, and they do have a seat at the table. So, and that was Helmut Kohl's big idea. So Germany is very committed to this. And I'll say one last thing. Markets can break a currency peg. They cannot break a single currency. Okay, we all know that you can break currency. Single currency, you can sell it, but so what? So the euro's gone down against that. That's actually a good thing for them, I think. But you can't break it. It'll be a political decision if it happens.
Let's go, Abby. You're on the spot on where
Let Abby
the
that's what
market's
she's
going to be.
famous for. So let Abby call the stock market.
I'd rather talk about exchange rates. I concur. I think that in Germany and France as well, there's a real political commitment to keep the euro as a system, and they will do what they need to do. We've all been disappointed at how long it's taking them to pull things together, to make the appropriate adjustments in bank capitalization and so on, but we think that there is no desire to break the euro at this point. In terms of the markets, let me answer the question indirectly. We think that equities are cheaply priced in the United States and many other places. Now, I could give you a forecast for the Dow, but we don't forecast the Dow. We do work on the S&P 500, which we think is a more meaningful measure because it's 500 companies rather than 30 companies, and it's a very substantial portion of stock market capitalization. We believe, and when I say we, I'm talking about the strategists who work on this, think that the U.S. equity market could rise 10, 15, 20% in price in the coming few months and much more over the next couple of years. But I want to talk about it in a somewhat different way. Let us assume that today's price is correct, right? Let's assume that today's Dow, today's S&P is the right price. What is it already factoring in? What is it already discounting? And we can use valuation tools that are called discounted cash flow models or dividend discount models or discounted earnings models. And what we know is that priced in to the stock market today is the assumption that we're going to have 3 to 5 years of double-digit declines in corporate profits. That's possible, but it's not likely. We think that growth will be sluggish and disappointing, but there will be growth. We don't see a recession. And so when we take a look at the S&P, which is now trading at roughly 12 times prospective earnings, and the historical average is between 16 and 18 times earnings, it looks cheap to us. So it's not just a matter of how grouchy everyone feels, and I think this has been a wonderful group in terms of pointing out the concerns and the worries and so on. But from the standpoint of investing, the question you need to ask is that gloomy picture already properly reflected in share prices? And our conclusion is yes, and even more than that. The other question that wasn't asked, that is the corollary, is so what about bonds? With interest rates at these low levels, what's priced in is a presumption that growth is going to stay funky for a very long time, that inflation is going to stay very low for a very long time, and if you believe that during the period of your investment horizon, whatever that might be, whether it's 6 months or 6 years or 20 years, if you think during your investment horizon that economic growth may accelerate a bit and inflation may pick up a little bit, then you have to ask yourself whether these very low yields, which to your point, ma'am, are extremely low, they are unprecedentedly low. Are they going to stay this low? Seems not likely. And if interest rates rise, whenever that happens, the mathematics say interest rates go up, bond prices go down. And that, in fact, could be quite risky. Right now, many investors who've been so upset about developments in the economy and developments in the equity market have been buying bonds because they're viewed as safe. Well, you have to look at the security and how much you're paying for it. And if what is priced in is a fabulous outlook for that security, beware. And I would say on the equity market, what's priced in is a pretty ugly scenario for that security, which may be what creates the opportunity.
We'll take one more question because he's had his hand up for. Yes, it's the third. Go ahead.
This is a foreign policy question. China has been the fastest growing economy in the world. It's now the second largest economy. But there's a lot of tension that seems to be in the air. What risk would you assign to protectionist, growing protectionist pressures?
Protectionist pressures in which direction?
Trade, just in
the
general.
U.S., or are you speaking?
For example, the Senate just passed a bill that was going to impose tariffs on China because of currency manipulation. Just as an example, what kind of risk do you see to economic growth as a result of some sort of outbreak of protectionist pressure?
Abby will take that. And this is our last question because everyone's been, I know we're holding people late.
I'm heading to Beijing on Monday. So I have been spending a lot of time thinking about these issues. I would encourage people who have an interest in that particular question to take a look at the transcript of a speech that Secretary Clinton gave here in New York last Friday, in which he talked about the fact that foreign policy in the 21st century must include the economic backdrop, that there is no difference between economic policy and the strategic positioning of nations. And one of the things that is very interesting is that the administration is now speaking more openly about some of the areas in which they think not just China but other nations are not being, shall we say, fair. The United States prides itself on being one of the most open economies. We don't actively control our currency. It's very hard to control the world's reserve currency, by the way. We mentioned before that we've just passed by the Congress 3 free trade pacts with other nations and so on. And so there is increasing attention on areas of unfair trade. Notice I didn't say trade deficits. Sometimes trade deficits are a natural outcome of the reality of the situation, but what is not acceptable is when things are unfair. And so I'll give you an historical example that I think is getting a lot of discussion now in Washington. You may recall that President Bush Sr. Was very concerned about the growth in the deficit, the trade deficit the United States had then, with the world's second largest economy then, which was Japan. And there was some consternation in the administration about how to approach it. And they began to develop a policy, which was then carried forward by the Clinton administration, which said, let's not worry about the dollar size of the trade deficit. Let's identify some very specific products where we think there can be improvement. And so there was an identification, as I recall, about 25 products where the United States was world class, where the US companies had a very significant market share everywhere except Japan, and asked the Japanese to explain why that was, and if they didn't have a good explanation, to fix it. So example number one, the United States at that time was a very significant exporter of motor vehicles, except to Japan. What was the explanation? The Japanese said simply, you put the steering wheel on the wrong side of the car, because the Japanese road system is arranged the same way it is in the UK. Well, you couldn't show that that was unfair trade. But then the next example had to do with distribution of goods through their department store system. And there it was shown that there was unfair trade that made it very difficult for US apparel exporters and accessory exporters to do well, and that was fixed in Japan. And so one of the things that is under discussion now in Washington, and of course the proposal made by Mr. Schumer a couple of weeks ago talks about it, and that is identifying specific activities which may represent unfair action and addressing those very specifically. I think that very few people, from a theoretical standpoint, support, quote, protectionism, and better to have a drive to the top rather than a race to the bottom in terms of who can be the most protectionist. I think the goal still is, among many, is to be as open as possible and encourage that. Keep in mind it was the United States that encouraged the Chinese to join the regional trade groups within Asia. And the focus, we think, is going to be increasingly in those areas.
Abby, thank you very much. Larry, thank you, both of you. Appreciate it. Thank you all.